And welcome everybody to the Horowitz & Company pop-up Q&A webinar. It is the 22nd of June, 2020. And here we are. First of all, happy Father's Day to everybody out there. And if you're not a father, happy Father's Day to your father. All of us fathers out there, hopefully you had a great weekend, an enjoyable one. You know, considering some of the things that we have to deal with right now in this crazy environment that we all live in right now. I mean, to be honest with you, things down here in Florida are a little bit nuts. And we are seemingly having an incredible amount of new cases reported on a regular basis. And in fact, I was going to have my father over my house. I haven't seen my parents since probably February. And we were going to have them over, maybe sit out back, do some social distancing, have a little barbecue, get together. And we decided at the last minute, you know what? Maybe it's not such a great idea. Maybe we're going to postpone it. We'll do some FaceTiming. We'll spend some time together that way because things are looking pretty bad in a lot of states. And we're going to talk about that a little bit today and maybe discuss a little bit why, in fact, it doesn't seem to be impacting the markets too much at all, if at all, entirely. Mention that, of course, before we begin, I am recording this. We put these on the disciplinedinvestor.com website once every 2 or 3. If you do require or need or want to have a replay, you can go check it out over there. The other thing I want to mention is important disclosures here. This is not a recommendation to buy or sell any security. This is for educational purposes only. Of course, investing involves substantial risk, and past performance is not a guarantee of future results. Of course, you could lose money if you invest. That's part of the process and understanding about investing. It's not all about simply making money. That would be great because then it wouldn't be what it is, right? But it is something that we do to enhance our wealth for our futures. And that's what we're talking about today. And as we do each and every Monday at 4:30. So a couple other things to note. Oh, please ask any questions you have. You can start loading those up if you choose to in the Q&A. No question is insignificant, too small. Anything you want to ask is fair game. So do yourself and me a favor and load those up so we have plenty of material to talk about. Again, this is your time. This is the opportunity for you to ask anything that you want, and I'll do my best to answer those questions and clarify and clear up and educate as best as I can. All right, with that, let's just talk about a few things here that I think are important and a quick, I guess, a recap of the week that we saw last week. Kind of messy week. It was an up week overall, although there was a lot of conflicting information going on in the markets. Remember something, the week before we saw that incredible downstroke on markets. That one day the Dow Jones Industrial Average was down like 7% out of nowhere, seemingly out of nowhere. And the S&P was down 5.5 or 6%. And then that recovery on the next day and then follow through onto the Monday. And then throughout the week, a little bit of an up and down situation that we saw that was pretty volatile. It does seem that the market did pop up very nicely, trying to recover some of those losses. But again, the sideways action throughout the rest of the week. And then on Friday, a downstroke that was once again due to what we've been seeing, right? This whole idea of these big headlines that are moving markets. And the one related to coronavirus, where we saw the spike in new cases in Florida and Texas and Arizona, South Carolina, North Carolina, California, and I mean a few other states around that are seeing just an incredible amount of an uptick in the new cases. In fact, more so than we saw pretty much ever. Now, some of that we could probably say is due to the testing, because there is a lot more testing that's going on right now compared to where we were. So, okay, we'll chalk that up. However, the positivity rates on these and the hospitalizations are also going up. So the testing itself, and you can ask anybody that's involved in this and know that it's not just the testing that is causing the increase in positive coronavirus cases. The fact, there's no coincidence here, that we did start to open up the economies, and we're still having the phased in opening of various cities and states around the country, is in fact adding to the reason why we are seeing an increase in new cases. And these big spikes in several states really spooked investors somewhat during various times of the day when they were announced last week. It didn't really stick too much because while we're seeing this back and forth movement of the markets, there is still I would say, a substantial bid to, hey, you know what? Let's get in every single time that there's a downtick. As a matter of fact, last night, overnight, at Sunday futures opened for a variety of reasons at 6 p.m. down about 1% or so, and then quickly started climbing up at about midnight into about 1 o'clock in the morning. And there was a drag on it. There's something called the fair value calculation that you use. And at the lows last night at about 6 o'clock, 7 o'clock p.m. on Sunday, it would have seen, if you would have opened up the markets right then and there, the S&P would have been down about 2%. And then we slowly but surely started moving up throughout the day for no real reason other than the fact that, again, people are desirous of getting in at any cost, regardless of valuations, and buying the dip. And so we saw the markets end on a positive note again today to start the week. Now, these big headline movers are going to probably start to get looked at as, well, we know that already, and let's get beyond that. So as we see that, there's kind of a wear and tear that it takes on investors initially when the surprise is there, when the surprise that we saw there was all that uptick in new cases, and then all of a sudden we find that, well, maybe there's a little bit of, we know that's happening, and we can plow right through that. That's how kind of investing works in a way when it comes to the data that we see. Expectations are a really important part of the process. When we see that expectations are X and we get within line, whether it's earnings or economics or right now with this whole coronavirus situation, we can deal with some things that are close to the mark, above or below a little bit. When we think that there is a lot of negativity that's priced in and things get a little bit better, well, things actually do better in the markets. When in fact we see that there is things that are priced in that look to the negative side and things come in negative, well, it's kind of like, all right, well, you know what? Let's get past this. We think it will get better in the future. And that's kind of where we are right now in all of this. So we have a lot of questions regarding the phased-in reopening progress. In fact, we saw like Miami say, hey, we're not going to be opening up any further right now because the cases that we're seeing, this explosion in new cases, is really too much. And we want to see how it's going to play out in terms of hospitalizations. Today, we saw that Texas is going to close down their quote-unquote overcrowded bars because the bars that they opened up are not playing by the rules that they set out, or maybe it's the patrons. Maybe they're being forced upon opening up to a great degree where this may be supposed to have a social distancing and wearing masks and maybe a spread of only 25 or 50% of the facility opened, whether it is in fact the bar or restaurant. And a lot of restaurants have turned into bars because the bars weren't allowed to be opened. A lot of restaurants got music. A lot of restaurants opened up their bars. And that was, for survival mode. And nobody stopped them. And people gathered. And the biggest spread right now is people under the age of, I think it's under 35. And that goes to play with the idea that, well, they're going to the bars, they're going to the beaches, they're going out, they're going to parties. And the problem is not so much that, because if we look at that, we say, well, people under a certain age, and let's just call it under 50, are much more able to handle this. Theoretically, that's what the narrative is, that, you know what, people are more susceptible to get gravely ill if they're over the age of, let's say, 65. So therefore, if people are under that age and they are, well, less susceptible to the tragic ending of how this disease works, not so bad. Yes and no. Because if in fact we have people under age 35 that are just going to the bars and going to the beaches and going to friends and all that, and they contract it, even if they're asymptomatic, but maybe are spreading it, that can creep into the older age brackets and cause a lot of problems to those people that are much more susceptible and can die from this. And we know that politicians are not going to close down unless there's extreme emergencies, unless the hospitals reach capacity. And I don't even know if in some areas they're going to care about that either. They want to make sure that this economy is open. And you know what? If some people die, well, okay. But you know what? We can't have everybody out of work because the financial toll that this takes is just too much to bear. So we are going to probably have individuals, people like you and me, and businesses, the ones that are going to be in charge of regulating whether or not they're going to go out and consume. It's very confusing, though, because a restaurant's going to want to stay open as much as possible and risk to an extent, it's not them that's spreading it, it's the people in the restaurant. And those restaurants that are only in it for the money, which a lot of people, of course, we can't deny the fact that people are in business to make money. It's their livelihood and they need to make money. They may take precautions, but their consumers, the people that come into the stores, into the restaurants, into the bars, into the movie theaters, it's their responsibility. And we're going to have to rely on those people to do the right thing. Does anybody think we're really going to see that those people are going to do the right thing in mass? Well, probably not. Because they're going to rely on the government saying that everything's open. So you know what? We got a green light, thumbs up to do what we're going to do. Go back to normal. We can't stand staying in our homes anymore. And there'll be some people that will be a lot more concerned about going out, of course. But it's going to lead to a lot of confusion. When we knew that everything was closed down, when everybody knew that you couldn't go out, when the stay-at-home orders were fully in effect, when the shutdowns of all non-essential businesses were there, everybody was in the same boat. We were all like, okay, you know what? We can't go out. We'll maybe order in, maybe not. We'll cook at home. We'll go buy our groceries and stay inside, not visit anybody outside of our homes, and we'll be safe. And we see how that's playing out in certain states. Now we have a situation where where a lot of places are open or phased in a reopening process, and it's very confusing. What do we do? So it's going to create an uneven environment economically because we don't know what people and how people are going to react to this. We knew it very clearly when everything was shut down. It was very clear. Nobody's doing any business. We may have some takeout business, possibly. We may have some delivery business. We may see grocery stores do very well. But the problem is that this level of getting back to where we were, or at least a sense of doing what we did before, is going to be very difficult for people to judge. And therefore, it's going to be very difficult for us to really judge how is that going to impact everything economically. So again, very confusing. For example, AMC theaters. They came out with an announcement last Thursday that, you know what, you can come to the theater, no requirement to wear masks. Everybody's like, what? No requirement? How can you do that? The next day, they reversed that. Anybody that comes to an AMC theater now is required to wear a mask. Apple, last week on Friday, caused some market disturbance, said, you know what? We're going to be closing down some stores. Those stores that we opened up, those states that are seeing a higher spike in coronavirus cases, we're going to be shutting down those stores in those states because we want to protect not only our customers, but also our staff and our employees. So again, we're going to probably be relying on, to an extent, maybe some of the government guidelines, like we see in other countries, where Beijing just closed down schools again, where they closed down a market, they closed down several zones, certain bars. So it's going to be very uneven moving forward because we're not going to see, I don't think, the political will of many governments in the U.S., many states, many governors. They will not be shutting down things because they know the financial hardship that they put on by doing so. Something I heard over the weekend I thought was really interesting, and we're going to explore this on the DH Unplugged podcast tomorrow night. It's live at 9 o'clock. This phrase of a gusher of liquidity. A gusher of liquidity. And that was related to central banks' monetary policy and fiscal policy. I thought this was really great Because if you think about what has happened over the last couple of months, we've seen an unprecedented, and that doesn't really describe the extent. It's monumental amount of money that is being spent in the trillions of dollars to prop up the economy, to make sure people have money, to make sure the stock market and the bond market stays up, to make sure that the banks and the financial system stays liquid and flowing properly. And there's a gusher of liquidity. Why are markets going up? That's a question I get that question I get asked all the time. We've talked about this so many times on Mondays. Why is the market going up? And we're going to talk about valuations in a second. Why can't we get, this reality check? And why is there such a differential between what we're seeing on the economic front on a domestic and international basis and markets around the world? It's not just here, by the way. Markets around the world are doing the same thing. They're acting very similar to what we're seeing here in the US. Drops are bought, pops are ride along with, because it's very hard to push down markets when you have this gusher of liquidity and the backstop, the implicit and the safety net by the invisible hand that's out there. And because we don't really have any visibility on earnings for companies, right now, people are ignoring what the facts may be. Investors are saying, you know what? We know that we have a government that's willing to spend. An announcement today that they're working on another $1 trillion fiscal program that's going to include infrastructure, possible extension of the federal unemployment, the special subsidy for unemployment for people, the $600 or whatever it's going to come out to be. Maybe it's only $300, or maybe it'll be an extension of the $600. But what is happening is that right now, people, rightfully so, due to this unforeseen circumstance that we're put in, and because of the 25 plus or minus million people that are out of work, are relying on the governments to make sure they have enough money. Some people, frankly, are making more money now than they were when they were working. Some people less. Some people are cashing in. Some people are hurting. What we're seeing, though, is that this next major event probably, aside from any of the virus-related things that are going on right now, is going to be a reality check when it comes to earnings. We're going to start to see in the second week of July, the banks are going to report and going to get a view of earnings and how they're progressing. Because while they did, a lot of these companies did pull their guidance forward, so we don't know exactly what they're going to call. And this is going to be the quarter that we're going to see a lot of the impact from the coronavirus shutdowns really hit these companies. The big issue is going to be, what do they see moving forward? And probably we are going to see that there is a lot better outlook. Listen, when we go from a zero output and zero growth and zero revenue in a time of a shutdown, or not zero, but very, very low number, whatever happens next is good. Whatever happens next is going to be a V recovery. The question is, how much of a V? We think it's going to be a small V. What I mean by that is it'll be a V and then just a not much more after that. So it's not going to be a V back up to the top of where we were. No, not at all. It'll be a temporary move to the upside, especially if people are going to start backing off due to the fact that they are seeing a significant uptick and people take it upon themselves to stop going out and spreading what's happening. I think there's going to be a reality check on the backside here. And again, most people and investors may not even be looking at this next quarter, may say, you know what, we know it's going to be really bad. We still got the Fed. We still got the liquidity from fiscal policy here and around the world. And maybe the economic reality of all this is just not important when it comes to stocks right now, especially in a zero interest world. Let's kind of skip ahead here and let's talk about something. I'm going to put something on the screen here. This is a quick update. We look at the Yardini numbers. We liked what he sees. I think he's a pretty realistic, group when it comes to buy side analysis. So it's unbiased. So on the left-hand side, you'll see the Yardini research. This is the post-tax cut from 2018 that we saw. I want you to skip down and look a couple of things. In 2019, we saw and we did see that there was, in fact, an actual $163 on the 2019 S&P 500 EPS. In other words, the earnings per share in totality of the S&P 500 amounted to $163. The consensus, of course, was right on from a year ago. From a year ago, they were up 0.6%. 2020, finally, this is the Ardini numbers, $120 estimate. So the move from, all the way up here down to 120, from 163 down to 120, pretty significant. We're talking about a 26% reduction. Meanwhile, we have stock markets that are close to their all-time highs. Now, what was interesting about that was that estimates over here, the analyst consensus, your traditional banks and analysts from the sell side were at about $150, $155 for the longest time. They finally dropped it down. Now, whether or not we get 125 or 120 or 130 or 110, really not the point here, but we are seeing that somewhere in the neighborhood, about a 23 to a 25% drop in overall earnings is going to be what the expectation is. And the worst happening in Q2. Right here. Big drop. Agreed by both the buy side and the sell side. Now, 2021, let's kind of skip ahead. In 2021, the expectations are from the Ardini side about $150. So we're going to kick it back up pretty strong, not up to the level we saw in 2019. So already, if we're looking at this in that respect, you have to say, well, wait a minute. Okay, we're going to get a nice kickback to the upside. Okay, I got that. And Ardini's at 150. Where we got the next part? Well, you got a 25% increase overall there. On the sell side analysts, they're expecting 164, pretty much right where we were in 2019. So you'd expect the year-end targets to get for the S&P 500 to be somewhere where we were at the end of 2019 or thereabouts. That would be a full 2 years or a year and a half out from where we are now. Not abnormal, not a crazy number, but a 30% increase. I'm not sure how we're going to get there, but okay. Let's take it out one more year, 2022. 2022, Ardini says we're going to get to 175. 175, okay? That's the number that we were supposed to get to in 2020 originally, by the way. Sell side has us up another 14% in 2022 at 187. So while Ardini increased by 16%, fact of the matter is that we're seeing that there is a significant increase in 2022, and it looks like people are looking past what's happening in 2020, 2021, going right to 2022 and betting that, we'll live through this and eventually stocks will be valued properly. But the question is, where are we now? This is something we've talked about several times, is the latest PEG ratio, price earnings to growth. Now, if you recall something, if you've been listening to me for a while, I was concerned about the PE ratio when it was kind of in this range here, about 2, right, approaching 1.9. And that was in late 2020. And I was very concerned that, one of the things we have here is an overzealous investment world that thinks that we are going to be able to get to significant levels and see that there is an opportunity to buy stocks at a significant upside price compared to where earnings are going to be. Currently, the PEG ratio is 2.3. Now, you may say, what's the difference between, 2 to where we are now, 2.3? A lot. What I would say is when we look at the PEG ratio right now, somewhere around about the 1.25 to 1.5 is kind of the area that you would say is not unreasonable considering as low as interest rates are. I'll even kind of boost it up to the 1.5 level right there. You start getting into the area that we see right now that is so overdone to the upside, okay, where we're starting to see that there is an extension of that, in these levels when we start getting over the top, oftentimes you see the next move significantly lower, right? We see these drawdowns that happen. And why do those happen? Well, those happen is because stocks come down significantly. And look at those dates. You have to look at some of these dates. We're talking about 2008. We're talking about 2011. These when recessions 2008, definitely a recession, okay? We see it here in 2000, after 1999, 2000, we start to see those rates come down. But here we are, significantly higher in this. And even in 2018, when we saw the market come down, we saw it come down very briefly, just for a moment, down to that 1.3 level again. We're in a historic recession, and we're not seeing that really play out. We're seeing the opposite happen, and this is what happens when you have the addition of fiscal policy and monetary policy to the trillions of dollar extent, thereby creating bubbles where you have a peg ratio 2.3%. It's not going to end well. That doesn't mean it's going to be today or tomorrow, by the way. Now, one of the things that could happen, let me kind of make one caveat to all this, is that stocks may continue higher and earnings do pick up dramatically because companies are making a lot more money, maybe somehow due to the low interest rate environment that we are in and the fact that we have a significant amount of overall money pushed into the economy. The expansion of our monetary base has been incredible. It took like 8 years to get the $2 or $3 trillion expansion that we saw recently, and then only 2.5 months in the most recent period. And that's why you're seeing this incredible move to the upside of an expansion of the PEG ratio, expansion of earnings that are not representative of reality. So anyway, something there. Like I mentioned, please get all your questions. We got a bunch lined up right now inside of here. I'm going to read one that came in by email. I don't think it's in here. Okay. This one comes from Aaron Rosenthal, and he writes, in your fantastic podcast, I'm reading this because of all the niceties here. Thank you very much. In your fantastic podcast, I'm a longtime subscriber, you made mention of protecting your holdings with insurance. Could you please return to that subject, if possible, in the pop-up today? There is no doubt in my mind that the coming earnings season reports will be brutal, and I just can't see valuations continue like this, but I'm a long-term holder, so protection is necessary. Thanks, by the way, for inviting me to immigrate to the States so we can get together. But at this age, the healthcare factor is important. Oh, Aaron from Canada. Yeah, there's a weird rule out there that says that registered investment advisors in the United States can't work with Canadian citizens. Still not sure what that's all about. Never have been, never will be. But anyway, to answer your question, Aaron, insurance. There's a couple of ways to do this, and I'm going to give you some generalities here because, that's what we look at here because I don't know your personal situation here. But first of all, when it comes to insurance, you may want to look at the area of protective stops for positioning, number one. Number two, option trading strategies. There is a potential if you have large holdings in any one stock that you could do things like covered calls, or you could do spreads, or you could do collars. There are different ways to look at this. Now, you said you're a long-term holder, which means that, you have a stock, ABC stock that you want to hold on to for the long term. But at the same time, if you get hit, it's going to be very painful in the near term. What you may want to look at is either puts, putting some put positions on to protect you on the downside, may cost you a couple of % of your portfolio over time. If it doesn't work out, so be it. You can look at selling calls against your securities that you own, thereby taking in some income. You could look at some protective stops on the positions as well. In addition to that, you may want to take out some broad-based insurance, whether it is like an inverse ETF or shorting an ETF on a broad-based market index that is representative of what your portfolio looks like, or outside of that. You can then look at also the opportunity to have, I mentioned calls. Let me think. There was one more thing I want to mention. And I just kind of lost the thought. I mentioned you could sell some calls, puts, inverse ETFs, hedging as well, and collars. That's pretty much all the things you could do there. Obviously, the other thing to do is to take profits and take some things off the top, roll back in when things come down. Now, that all will also be subject to taxation issues. That could be an issue that you want to look at. But there are a lot of different things you could do, small little pieces of the insurance pie to make sure that you are taking care of the positions that you hold. The final thing in this, I think, is not so much insurance, but an idea and a concept. And the concept is diversification. Boring maybe, but diversification does help to, at times, mitigate some of the risk inside of your portfolio and potentially limit it. Because if you have a diversification versus maybe a major holding in one security that has a 20% drop, the fact is if you have 50 different securities or 100 securities in a portfolio, the probability is they're all going to drop at the same time. And then if you have things that offset, for example, maybe some bonds or alternative asset classes inside your portfolio, that could be beneficial as well. Okay, here's some other questions that came in through the Q&A panel. This comes in and says, do you have any thoughts on solar energy? For example, Solar Edge, SEDG, Enphase, ENPH, or Sunrun? By the way, a weekly podcast listener, I think actually both Solar Edge and Enphase are recently additions into the TDI managed growth strategy. We hold those positions. I know Enphase we do, SEDG. I call it SEDG. I don't know why. It's actually SEDG, but I call it SEDG, which is Solar Edge. I think there is an opportunity for a lot of green energy to happen, especially if we see a significant amount of money pouring into various ways to enhance the economies around the world. Obviously, much of the world, not all of the world, but much of the world is, really trying to get off fossil fuels and have renewables as much as possible. And I think that is going to be something that's with us for a long time. So I do believe that good stocks in the area of green energy or whether it's solar, whether it's wind power to a degree, whether it's ocean power, whether it's anything related to that could be something that is very much benefited by the next round of what I see stimulus being related to infrastructure. Look at how governments will try to stimulate, and this is so much they could do. And one of the things they want to do is try to do things that bring jobs, and where best else can you bring jobs into the area of infrastructure? I mean, I do agree that that is something. Now, obviously, a lot of that's going to be wasted because government projects always have a tremendous amount of waste, but nonetheless, it has to go on. So I do think that you're on the right track there. I can't recommend any individual securities. I will tell you, though, that a couple of those are in our portfolio. They met our strict and stringent filtering and screening processes to get in for a growth-related company that has consistency of earnings, consistency of revenues, good margins, ROE, trading volume, technicals, etc. Hope that helps. Doug asks, I have 5 boys, now men, age 27 to 19 in age, boys to men. That's great. They are now starting to invest. How can I convince them the folly in trying to time the market? I tell them I'm blue in the face, but it won't work. They won't listen to me. They have to learn the hard lesson on their own. Any suggestions? Yeah, Doug, good luck. Especially in this market right now, where you have a lot of people thinking that it's just easy peasy to make money utilizing an app, and they're playing it like a game. You have to explain to them, I think, the idea of, are they doing it for the fun of it or to make money for their future? One of the greatest ways to increase wealth is to buy, whether it's good companies or good markets, for the long haul. That doesn't mean you can't trade them, but you have to have some solid fundamentals behind them to a degree. They're not going to listen to you, I don't think, with what's going on right now. It's probably going to have to learn on their own, but maybe explain to them, maybe present to them the idea that, why don't you take some of your money, invest it for the future, let it do its thing, even though you're going to want to, they want to look at it every day. Back in our day, listen, back in the day, you couldn't look at it every second of every day. Now you can. I have 3 screens in my office, 24-inch screens dedicated to markets, to monitoring what's going on at all times. Why? It's just the way it is right now. It's not necessarily to trade, it's just to keep informed. But you could know exactly what's happening at every single second of every single day. And that's what they're doing with their phones, with their apps. I would suggest to them respectfully that what they do is maybe carve out some of their positions to trade and some to invest. And, if they can't learn, like you said, they're boys to men now. They are going to do their thing. I mean, everybody who starts out and thinks they are invincible in the beginning of their investing career finds out soon enough that it's pretty much impossible to time the market on a regular basis, or else everybody would be doing it, and there would be no markets, right? It's just a fact of what it is. I wish you luck. I don't know how you're going to do it. This one's from L. Bernstein. Andrew, love your podcast in this Q&A session. My question is regards to Microsoft. They had an all-time high today, and they've been doing a great run. Do you think the stock price is too inflated related to the index buying, or the fundamentals warrant the price? You know, I go back and forth on Microsoft because I think Microsoft has some really great products. You know, don't forget they have Teams, which is an important aspect of the new quote-unquote work-from-home environment. You know, Skype and LinkedIn, which is important if people are going to be wanting to get a job. Everybody's going to LinkedIn. Not to mention their Office products, of course, and their Azure and their cloud product, and the list goes on and on and on. They are situated very well. The one thing about Microsoft I find interesting is, you know, a lot of the money that comes in from them is seat-based revenue. Now, not all of it. And you would wonder why they wouldn't take a little bit more of a hit if there's this big unemployment right now, and if some of the companies are going to renegotiate some of the rates with them. However, we also know there's a disproportionate amount of people that are unemployed that are non-office workers, that are maybe Microsoft Office users. So it is kind of fascinating. I think there is a disproportionate amount of index buying that's going on right now. But Larry, I do think that Microsoft is a great company overall. Again, another company that we own. But I think that it is, there's something to be said about the fact that it had a pretty good run here. I don't know what the backtrack is, but they have a great model, great product line, really excellent management, and fundamentals that are fantastic. Jamie asks, thank you for taking my question. I've always believed in diversified portfolio, but I'm struggling to continue to buy bonds at the current yields. It seems to me that there is more downside risk than upside potential. I took some off the table back when the 10-year was below 50 basis points and have not found a good way to put it back to work. I've heard your 1 foot in and 1 foot out approach to investing in equities. Can you talk to me about how to approach the fixed income portion of your portfolio bond prices at an extremely elevated level? So Jamie, I think your point is really well taken here, because pretty much every asset class right now is blown out, right? And that makes it very tough to find value. And I heard some discussion over the weekend from some really well-schooled and well-seasoned bond analysts and investors that are saying, you know what? Very difficult, especially for bonds. If we have all this money coming in from the Fed and they're directly purchasing bonds, indirectly and directly purchasing bonds, and especially on the corporate side, you know, how do you get any yield? One of the things that we do is we stay with a shorter duration portfolio, because I think with a shorter duration portfolio, you are less apt to have the volatility if in fact things go a little haywire when it comes to the bonds, especially if you notice that if you think about bonds that are on a little bit of a lever, and the left-hand side of that lever is grounded to the axle, if you will, and the right-hand side moves up and down, that right-hand side moves much more than the left-hand side moves. What I mean by that is when you see rates changing, you will see a much more extreme move in the bond pricing for long bonds. So our approach to this is to stay high quality, low duration or shorter duration, and shorter maturities overall, you know, under 10 years, under 7 years, and a lot of the portfolio based on high grade and good quality. Now we'll mix in a little bit of lower grade in there to an extent, but again, the majority of our portfolio, if we look at it in totality, is a much lower, duration, shorter maturity portfolio. So we don't really have too much of concern because we have the high grade in there as well. But yeah, I do agree with you. It's kind of like a scratch your head time, because what do we get the next move on bonds? I would be happy just investing in bonds just for a decent coupon. Isn't that the whole game, right? I invest in a bond, I get the coupon, one day it matures, I get my money, I reinvest it somewhere else, I get a decent coupon, and that's it. These days, people are investing in them for the total return of not only the coupon, but the increase in the valuation of the bond due to the fact that yields are going down. It's been a great bet. been a great investment for about 15 years now. 15 years. The only thing that can be better, dare I say, is if in fact we have, I don't know if you know I could say it with a straight face, but negative rates, negative yields. That will even bring prices up even higher. And that's what people are betting on. They're betting on the Fed staying at a low interest rate for a long period of time, and in fact having to invert this and go to the negative side, the dark side of the bond yield category to get a total return that's even higher. I'm not betting that. I think it's very destructive to the economy. It's horrendous for the banks, for the financial institutions. It destroys savers. Just a lot of bad going on there for the sake of holding up risk asset prices. So I think what you want to do is find good quality bond mutual funds, frankly, or I don't like ETFs for this at all for a lot of different reasons. But you find good quality managers in that area and go short duration on that. Best I can give you on there. Jack asks, any insight on NKLAW? Each Nikola warrant gives a holder the right to buy Nikola common stock for $11.50 after July 6th. They both closed, let's see, Nikola closed at 70 and 34 plus today, respectively. If the warrant expires today, the investors would net about $25 per warrant. How so? I'm not exactly sure how this is all playing out, to be honest with you. I just know that there is some upside opportunity, but there's no free lunch. Let's just get that straight, right? You have to pay a price for that. So I think it's probably properly valued unless there's something crazy going on in the market, and that kind of arbitrage doesn't really usually speak very clearly as you're describing it. We don't usually mess around with the warrants too much because there's a lot of things that can happen there that oftentimes are not as on their face as apparent as it would be. So this is a stock of a company that is quote unquote the next Tesla. That's what it's being billed at and being billed as. And they have no revenue. They have a couple of trucks out there. They have no sales. But then again, neither did Tesla for a while. Tesla stepped up their trucks and trying to get that out. We got Ford now coming out with electric trucks in 2 years as well. We've seen companies like this go in and out. Right now, it's the hot play. Next question from Doug. Are these new Robinhood day traders really moving the markets to crazy levels, or is it the algos? Yeah, both. Robinhood traders really don't have the firepower to move markets. They can move stocks, and stocks make up the markets, yes. And there's a lot of money coming in with people who don't really care about their money, it seems, because they're buying things that just make no sense. And they're buying Hertz, they're buying bankrupt companies like Whiting Petroleum. They're going after names that really are a mess. They're going after the cruise lines and the airlines without any regards, thinking, you know what, hey, one day they'll go up. Maybe this company won't go bankrupt. You know, that's kind of theory. And if I lose a couple $1,000s, I don't care. They're not really trading. They're gambling. They're playing a game. It's like a game. I mean, the only thing you can have right now is, you know, somebody broadcasting this on Twitch. And that's the next thing that I think we're going to see here. The fact of the matter is, and we are starting to see some of that already, you know, but with this, with where we are with regard to the Robinhood traders, I mean, I don't really think that they have the power to do so. Henry asks, can you repeat where you find the recorded webinars on the yeah, so if you go to the disciplinedinvestor.com, right to the right, it should say replay. Something of that nature. Replay of whatever the date is. It's right to the right-hand side or under, there's a couple different places you can find it, but it should be right to the right there, midway down to the right-hand side. You'll see it. Or you can click on the, I think it says blog or something of that nature. That'll be right there. The latest that comes off. So you can check that out. Here's a question that came in. Let's see. My father passed away Memorial Day. I'm very sorry to hear that. He had an RIA with one of the big banks managing his accounts. I think you mean IRA. When I looked into them, I was shocked. He was holding inverse leverage ETFs, many swing trade positions in held less than a week, zero long-term holdings. When the RIA found out my father passed, he sold every asset in the portfolio the following day. The account has a negative 3% over the past decade. How would you approach dealing with this and appealing distribution? I don't know. I don't know. I can't really comment if it's there must have been a reason why the strategy did what it did, and your father must have agreed to it for somehow, and he was holding it. How long did you say he was holding it? He was holding it over the past decade. So I would think that there is some reason that he was holding this as maybe a diversifier. I can't really speak to it because I don't know. I mean, I don't know if that's necessarily, if your father didn't know what they were doing and he didn't agree to it, he probably wouldn't have had the account. He had the account for a long period of time. So unless there's something else going on that I'm not aware of here, sometimes people want to be in short-term holdings, and they want to be in, like, for example, our TDI managed growth strategy, has inverse ETFs in there. There may be sometimes leverage, sometimes not. I'm kind of looking through your list here. Long-term holdings, we have some long-term holdings, but we do rotate the portfolio on a quarterly basis. I think that what the appropriate thing to do, I'm not sure about if the RA found out that your father had passed away, sold everything in the portfolio the following day, that should have been from a discussion with somebody about that they wanted to sell that out, or that they was by contract that they were to do so. A lot of times we are asked to sell the accounts out when somebody passes. So, or it's by contract that if someone passes, you can no longer trade for the account. Therefore, you have to move it to cash because you no longer have authority to trade on the account once the party passes. Therefore, you can't really hold the account. You have to put in cash, or else that you would not be working with the strategy. So I don't know. I'm not sure. If you want to contact me separately, we could talk about that, and I could take a look at what one of the banks and what they were doing and what the strategy was, and it was appropriate. But it all depends. It may have been very appropriate. That may be exactly what your father wanted. It may be how he wanted to invest for some reason or another. And maybe it was, again, a diversifier. We utilized that kind of strategy to a degree, not necessarily, but to a degree, with adjunct of other investments for people as a diversifier. So, I mean, it may make sense. It may not. So if you want to contact me, send me an email at info@horowitzco.com right here. Send me an email. Let me take a look what's going on. We can go through it. Tim asks, Andrew, can you briefly explain how items CPI is calculated from indicates from little to no inflation? We look at the housing market, cover the podcast stocks, so he's asking me basically, how is CPI is CPI a useless tool? CPI is not necessarily useless. I mean, one of the things I always joke around about is that we have incredible amount of prices that are going up, but no inflation. It all depends on how we're calculating that. You can look at alternative stats at different places, like a place called Shadow Stats that will give you the old way that inflation was calculated. Some things are costing a lot more, yes. Gas prices are down. We know that, for example. Tuition is up. Healthcare is up. Food prices are down. So it all depends on what's being utilized. And the fact of the matter is CPI is taking this all into account. And you could look at things like, CPI headline numbers, CPI core. For the most part, I think that CPI is a relatively important number, but we also know individually that things are going up. You're not going to see a 1.5%, 2% inflation rate really on a one-year basis being anything too concerning. However, if we take that over a period of time, we take that over, 10 years, we're talking about a when you compound it, 25% increase in prices. So it kind of sneaks up on you over time. For whatever reason, the Fed and many of the central banks around the world have decided that 2% is the number that they want. That is their mysterious number that they want to have in terms of inflation on a year-over-year basis. Now they're also willing to go over that level. And that's all about making sure that we don't enter into a deflationary spiral, which is very bad, which you may say, well, with deflation, I don't mind if things cost less. Well, yeah, you do. Because what happens is a deflationary spiral really causes a big problem from an economic growth standpoint, and from people not wanting to pay now for something and waiting, and it just messes up the economy pretty significantly. So the CPI tool is interesting. We see that this week, I think on Friday, we're going to see CPE, which is consumer PCE, personal consumption expenditure. Sorry, PCE numbers are going to come out, and that's the the most looked at data point by the Fed when it comes to inflation. So look at that one. I think that will be a little bit more important to look at and see what's happening. CPI itself, I don't think right now is that important, because unless we see a spike up dramatically, the Fed is going to let it overrun for some time. Ben, he says, can you discuss how to read the KRI image compared to -7 to +7? So yeah, the KRI is a key reversal indicator, and basically it's a slow moving indicator. Sometimes it gets overdone to the overbought levels when we start seeing a +5, +6, +7, which we never see a +7 very often. That's a big concerning point, that markets are very vulnerable to a sell-off, then potentially moving back into the same mode, which is exactly what happened. That +7 was a real indication that something bad was going to be happening, and possibly, it would taper off like it did. I still am of the mindset that we are well overbought, even though the KRI today, I think, came in a +1 or +2. So it did come down from that +7 level. When we see it's a -5, -6, maybe -7, which we don't see that often, we don't see the pin of the number on the gauge up to a +7 or a -7 very often. -7 being oversold, +7 being overbought or overheated. When we see those numbers, though, and we see them consistently in a culmination of a couple of days in a row, in particular, we get something that we call a cluster. When we start to get a cluster, that's where we really get concerned. A one-day wonder, okay. Something just kind of gets a little wacky when we look at our indications and how this is built from the psychological and technical indicators. We see that we are at a +5, +5, +5, +6, +5, +6, +7. That is getting concerning when we have a consistently high number that gets off the charts and pins it down. Same thing on the negative side. It's time we want to think about on a +7, taking off some longs, maybe hedging out a little bit. On a -7 is getting out of your hedges and going long. So kind of either side. All right. Doug has one last question. With all the stimulus the government's throwing at the market, what should be a novice investor start looking at to see if inflation is around the corner? I'm trying to figure out when we start investing in gold, Bitcoin, other commodities. You're not going to see it. It's going to happen very quickly, to be honest with you. I don't know if we're going to see it. Technology is keeping down inflation very significantly. I do think that there is the opportunity to invest over time inside of those different areas that you're looking at as alternatives. And again, it will sneak up slowly but surely. Look at what gold has done already. Hitting a multi-month, I think, high sometime today. Last question is from Jamie regarding the account when my father passed. Oh, he didn't know the difference between an ETF and an ATM. Oh, this was an RIA. When they liquidated, they replaced it all with vanilla index funds. He knew this. He knew because my mother left a voicemail over the weekend, but thanks, I will email you. Yeah, let's check that out and see what the story is on that. That's a little strange also, that I want to see what they did there. RIA, if they're commission-based. Jamie, email me, definitely email me. Let's check that out. All right, that's going to conclude today's session. Hey, thanks so much. We got, I told you something when we first started this, and I said, we'll do this as long as there's interest. And I was thinking, what, maybe through March or April, there'll be interest, and then people go back to doing what they do, outside, go and doing their work. But you know what? We're still pretty much at capacity here, and we'll continue this for as long as we can. So thank you for joining me, and I will see you again next week. Have a good one. Stay safe.